All right, good afternoon, everyone. Welcome, and thank you for joining us. My name is Brian Humphrey, Director of Distribution for Advisors Preferred. We're a sub-advised fund family. We're pleased to be hosting this series of webinars with the theme of From Chaos Comes Opportunity. 2020 has been quite a year so far, but at Advisors Preferred, we're proud to have managers who have fared very well during these difficult markets. It is my pleasure to introduce Jason Teed from Flexible Plan Investments. Jason is a co-portfolio manager for the Quantified funds and the Gold Bullion Strategy Fund. Flexible Plan is an innovator with a rich history in the risk management space, managing approximately $2 billion today. We'll get started in just a minute, but first, a couple of housekeeping items. First, we are recording today's webinar and can make available a replay to you should you wish. And secondly, we will have a question and answer session following the prepared presentation. If you have any questions, please submit those through the question and answer interface in today's webinar. I'll hand it over to Jason in just a second to speak about Flexible Plan at a high level. Then I'll come back and explain how we work together as firms. And then after that, Jason will go through the specific investment methodology. Jason, the floor is all yours.
Thanks, Brian. Okay, so first I'm going to talk a little bit about flexible plan investments. We are primarily a risk management firm. And as it says here, we believe clients and their advisors deserve more than traditional buy and hold asset allocation. We think that over the long term, risk management is just better. Managing your risk puts you in a better position going forward throughout the entire market cycle. And we believe that doing this reduces the timing importance in your investment portfolio. So what do I mean by that? Let's say that you're a young person and you start investing in let's say 2006, 2007. The first couple of years, you're doing pretty well with your investment portfolio, and then you're at a significant disadvantage once the bear market occurs. If you were to use a risk management process during that period of time, though, that can smooth the investment returns, making it less of a concern when you begin your investment portfolio, or indeed when you end it. So we believe that overall, active risk management can provide a better experience for an investor over the entire market cycle. And so what do we call that? We call that dynamic risk management. And the key thing that I want to emphasize here is that we are entirely quantitative and use no discretion whatsoever. So we design quantitative models to trade the markets. And beyond that, there is no override process in place. There is no way for us to override the signals that we are given once we put a model into place. And this helps us remove emotion from the investment process entirely. So our job is to make sure that the models continue to perform as we expect, regardless of what the market is doing at any one point in time. And having a quantitative methodology really helps us stick with our own investment principles, even when markets are volatile and it's easy for emotions to come into play. And our risk mitigation depends on the markets, and our models adapt to what the markets are telling them, not what we think is going to be happening going forward. So those are some key points of the way that we do investments. Another thing that we emphasize is what we call strategic diversification. So you've probably heard of diversification in the traditional asset class sense, where you would want to diversify across different asset classes to smooth your investment returns. So asset classes that have lower correlations you'd like to have in your portfolio so that at any one point in time, it's more likely that one asset will be performing well, making it easy for you to stick with your investment plan. We like to do that, but we like to do it among our different strategies. Strategies work in similar ways to asset classes in that different types of strategies work well in different market environments. This is a reality. Like a trend following strategy will perform differently at different times than, say, a strategy that looks at markets that are more range bound and profits from those. What we like to do is create a portfolio of strategies that complement one another. So at any one point in time, some portion of the portfolio is going to be outperforming to further smooth those investment returns. And this really does help mitigate portfolio risk and potentially can increase performance. But the key thing is that it smooths the curve and helps you stick with your investment methodology. So if your investment returns are a bit smoother, less emotions are involved, and you really can stick with what you've planned out. One of the ways that we do that here is you can see here on the side, we split the markets into bull, sideways, and bear markets. And we do check to see how each of our strategies perform in those different types of markets. And that's just one of the many ways that we want to make sure that our strategies complement one another. So with those principles in mind, I'm going to pass things back off to Brian and let him talk to you about how our firms work together.
Great, thanks, Jason. Great overview. Gives people a really good sense for what you all do. We'll dig into the details in just a minute. As I mentioned at the opening, I'm with Advisors Preferred. We're a sub-advised fund family. And we work with leading managers like Flexible Plan to bring their ideas into the mutual fund space and make them available to advisors like yourselves. Under the relationship that we have with Flexible Plan, which we enjoy very, very much, Flexible Plan has 9 mutual funds with us. They're listed here on your screen. 8 of them are under the Quantified brand, and we'll be talking about the STF fund in just a minute. That's the trend following methodology. Also highlighted is the Gold Bullion Strategy Fund. We thought it was important to spend a little bit of time on that as well today under the backdrop of chaos. And when everybody thinks chaos in the markets, chaos in the world, everybody thinks gold. And Flexible Plan had the foresight years ago to bring out a gold, essentially a gold tracking mutual fund that's available. So those are the 2 funds we'll be speaking about today as part of our bigger relationship that we have with Flexible Plan. I'll also note that the Gold Bullion Strategy Fund is also available in a variable insurance trust format for anybody that does variable annuity business. More information for all of the funds can certainly be found at their websites. We pulled out a fact sheet here for the STF fund, which can be found at quantifiedfunds.com. And the same is true for the gold fund, which is branded and marketed a little bit separately, but still under the same umbrella at Gold Bullion Strategy Fund.com. I'll also note on the Gold Bullion Strategy Fund.com website, there's a fantastic white paper that the research folks over at Flexible Plan have done in terms of how much of your portfolio should be allocated to the gold fund. And it also talks about how gold generally performs during different market cycles and different market regimes. Moving to the STF fund, or moving back to the STF fund, I should say, some highlights in terms of its performance. As you'll see on the screen, it's currently 5-star rated by Morningstar. It also enjoys the same highest equivalent ranking, or rating, I should say, under Lipper methodology. I'll also note that the STF fund in the calendar year 2017 was the #1 performing equity fund in the entire Morningstar database. So for any domestic equity mutual fund in all of the US, this fund was the #1 performing fund in 2017. I'll also note, as of last night, the fund is #1 in its category year to date, which is the tactical allocation category in Morningstar. It is the #1 fund year to date as well this year. So with that, I'll pass it back to Jason, and he'll go through the methodology in both of these strategies.
Thanks. Okay, so first I'd like to start off by saying that self-adjusting trend following is not a fund that came into existence just on its own. The model was not developed specifically for the mutual fund that was launched in 2015. This strategy has actually been traded internally with our firm. We did bring on and create this within a mutual fund wrapper so that we could bring this strategy to more clients and offer it to them in a more fee-sensitive manner, a less costly manner. So when we did launch this fund roughly 5 years ago, we had already been trading this strategy for quite some time, and had quite a bit of live experience with it. So we were determined that the strategy was one that was a good long-term model for investors, and we wanted to bring it to market more broadly. So that's why we launched this particular mutual fund. So we do have results that go back a little bit further than the fund since inception. But let's dig into a little bit of how the fund works. So basically, this is a NASDAQ 100 fund. It trades the NASDAQ 100 as the only asset class it really invests in. It will either be invested in the NASDAQ 100 or in money market. And you can see that we've got the 4 positions that it could potentially be in listed here. So money market we'll utilize when we don't find any identifiable trend. We'll use the NASDAQ 100 at a single leverage when we detect that there is some level of trending market. But when we see that there's a really strong trending market, when our signals are very positive that the movements of the markets are going to continue, we can leverage up to 2 times the NASDAQ. And then conversely, in periods where the NASDAQ is not doing particularly well, we can go inverse the NASDAQ. So this is an absolute return strategy. So there can be periods of time where we significantly deviate from the underlying. And we think that that's a strength overall. And I think our past returns show that that's true. And the fund does use the relationship between moving averages, rates of change of those moving averages, and we use the daily closing prices to generate signals. Seems simple enough. And you can see here that we've got like the specific types of moving averages that we use listed out. I would say, you know, we do use these identifiable trends, but if you were to look at what our trades are, you're not probably going to be able to reconstruct what we've done from these data points, because we look at how these data points complement one another, what their relationships to each other are. So these aren't simple moving average crossovers or things like that. We do look holistically at many different aspects of these indicators. So what are they doing? Are they trending themselves upward? Are they moving towards each other, moving apart, things like that? So this really is a composite rule set, and those rules all work together. Additionally, the rules can be contingent upon one another. So we've looked historically to see, you know, when relationship A is accurate, you know, what does relationship B say? Does it say anything significant now? So there can be some contingent relationships here. So we're not simply looking at these moving averages, but also the relationships. Another strength of the strategy is that we use a committee of signals. So we need confirmation. We look at agreement among the rule sets that we have. So this isn't just a one and done. We like to make sure we know what we're doing and that multiple parts of the algorithms are in agreement. One other thing that we do, not specifically listed here, is that we also adjust for volatility, which actually helped us pretty significantly this year, which I'm going to get into in just a few slides. We do target a specific level of risk that we do not like to exceed. If the market volatility is too high, we will pull that position back to be a bit more conservative. So we'll either reduce the leverage point or we'll start moving that position to cash. So that being said, allocations, as you can see here, can range from 2x leveraged to 1 time short, but we can be continuous. So it's not always a direct jump from double long to single long to neutral to inverse. We can have continuous signals between that. So let's take a peek at what some of these indicators look like. So these are the main inputs that we like to use. So we've got the 5, 10, 50, and 200-day moving averages. And you can see, obviously, some of them are not very responsive. This is this year, 2020. As you can see, the 200-day moving average is quite slow, didn't really respond a whole lot to the market downturn just because it was a very, very fast downturn. So the 200-day didn't have a lot of time to respond. Where you can see the shorter, the 5 and 10, they changed very, very much, and they start to loop around one another back and forth, particularly as the market began to recover after the initial drop. So like I said, we're not only looking at their level, but the direction that we're heading in and the relationship between them. And We do like to take into account both the longer and the shorter term nature of market trends. So there are different aspects to market trends. So the longer one, the longer components of momentum can make up the long-term changes that we see in the strategy, but we still have the ability to play around with those shorter-term trends as well. So we may be stuck in a long-term trend upward, but in periods where there is a little bit of market movement downward, a little bit of play there, we can slightly adjust our position based on what those shorter trends are doing. So all of this coming together does result in there being long periods of time where there are no trades at all. So one example that we had was 2017. The strategy had no trades at all for 2017. That was a very consistent market, both on a long-term and a short-term basis. But there can also be short periods of time with relatively frequent trading. These are usually high volatility periods or periods where there's no clear trend in the market. And we'll see that in subsequent slides. We did experience quite a few different trades this year. And let's talk about how the fund can use leverage. We can add leverage in trending markets to increase portfolio returns, given that the market risk is not particularly high. So when volatility is a bit lower than average or trends are particularly strong, we do see high leverage in this strategy to increase return, as long as we're keeping risk at an acceptable level. We do use futures to trade all sides of this strategy, so both long and short. However, the short positions, as I've mentioned before, are not going to be leveraged in any way. We have found that in previous research, doing any type of leveraged inverse position really is a bit too risky for what we'd like to do. It's much more difficult to control that type of position. So we feel much more comfortable in doing just the 1x short as our maximum inverse position. And, bear markets also tend to be periods that have higher volatility in general. So increasing to a double leverage position would probably get us higher than that risk level that we have assigned for this strategy. So we just feel like leverage on the short side is probably a little bit too risky, so we don't see that in this strategy. So how do we manage volatility with a strategy? So I've kind of alluded to that in a few of the previous slides. Primarily, we do that in positions to money market or inverse equity. And we do use our proprietary targeted volatility analysis to reduce this day-to-day risk. So the thing to keep in mind here is that we can still profit during bear markets. So not only are these inverse positions a tool to decrease risk, they're also a tool to increase return. The only thing that really matters to this model and to this fund is that there is a trend. It does not matter which direction that trend is in. So as I've mentioned, there is an upper limit to the volatility we like to see, so we aren't going to exceed that level using the TVA. When TVA is more active, that's when you tend to see more trades occurring within the fund. So as we're going to see on slides later, we do publish the positions that we have in this fund, and you'll see that they're much more active during periods of time where there's high volatility. So let's take a peek at how our strategy traded this year. I know that this is a lot to take in. This is a very active trading period for this strategy. It's a bit uncommon. We don't typically see this frequency of trading, but it was a very volatile period of time, both in terms of market standard deviation and the rapid changes in market direction. So I'm going to guide you through all of this information here. So the main things to keep in mind here are that before the market downturn, we see pretty consistently high exposure. So the 200 to 160% exposure you'll see before the market started to downturn. And then fairly quickly, the algorithm dropped to below 1x long in late February. And from there, it reduced all the way to zero exposure on March 23rd. So you can see that our risk management did continue to decrease exposure down until zero. As the market began to recover, though, we did see the program wade back into market, slowly increasing as the markets continued upward. One thing I did find interesting to note here is that we fully re-entered the market at 100% exposure at a price that was lower when we initially exited a position that was greater than 100%. So overall, that trade was successful. And then you do see that we further increased exposure up to the 200 level later in the year as markets continued to recover, just below where the markets had topped out previously. There was a little bit of a pullback in July as volatility increased again, but the strategy further increased exposure after that. So that's kind of how it handled that initial drawdown. Because this move was very fast in terms of a bear market, roughly 20 days or so, not all of the strategy's components actually came into play here, so we didn't see a short position. This strategy, had it been a much longer bear market, like we saw in the 08 period, significantly profited from inverse position. But because the bear market was so quick to materialize and so quick to disappear, we didn't see all of the different components of this strategy come into play. However, even with such a speedy drop in recovery, the strategy was still able to navigate the situation well due to the rapidly trading components of the strategy. So overall, we were quite pleased with how we were able to navigate the markets during this period of time. And a couple other things that I'll note. This is obviously an aggressive strategy. It is designed to be high return and potentially high risk as well. It is also a trend following strategy. So there are going to be periods of time where it doesn't do quite as well. And those periods tend to be where the market lacks direction. So that'll be range-bound markets. So going back to what I'd said before about strategic diversification, we do always like to see this strategy paired with something that's going to excel in range-bound markets, so that at any one point in time, your portfolio is getting some exposure that's going to be doing well. So we like to make sure that you're diversified in that regard. So just keep in mind that this is an aggressive strategy and your portfolio should be positioned with other components that will complement it, to sort of mitigate some of the risks that you take on with a strategy that works like this. That being said, let's move on to the gold fund, which potentially could be used in similar situations. Gold tends to perform quite differently than equities. So potentially when equities are range bound, a gold position is not something that you should not consider. So our gold bullion strategy fund, which is ticker QGLDX, is the first and only no-load gold bullion fund available to mutual fund investors. So in the past, all gold funds have been composed of gold mining stocks. And we have found that this really isn't a very good proxy for gold. There can be periods of time where gold miners significantly deviate from what the underlying gold exposure is doing. So we've been able to come up with a proprietary fund setup that allows us to create this fund in a mutual fund format that's taxed in a more traditional manner, not as like a collectible, and there's no K1 on our fund. Our fund's goal is to be appropriate for investors looking for gold, daily movement of gold bullion prices, or something that is not correlated to equities, but otherwise wouldn't have that particular exposure. On the next slide, you can see like it's called a strategy fund, but this fund is a tracking fund. So it's not a strategy per se. It doesn't seek to outperform gold. You're only looking for the rise and fall as the price of gold bullion changes. It does allow a strategy that can work in the client, to the client's benefit compared to owning gold bullion. And we're able to do this tracking using near-term futures to capture all of the price movement of gold with only 25% of the fund's assets. So we've designed it just to track the price of gold. So it is going to have a lower correlation with the equity markets, and this is an ideal fund for diversifying positions. We also use a collateral portfolio setup that we use to try to offset some of the fund's expenses. We invest in income securities, including government and corporate bonds, high yield accounts, and CDs. So that doesn't account for our nominal exposure to gold. That's just how we fund the rest of the portfolio. And there are going to be some day-to-day fluctuations in security like this when you look at it versus the ETF or the gold spot. Since you'll notice here that our cutoff is at 130 when the futures trading close. So over the long term, though, that's not going to cause any price differentials, but you will see on a day-to-day basis that they might deviate slightly. Now let's take a peek at performance. You can see that for the most recent quarter, we have outperformed the GSCI Gold Index. That's a gold futures-based index. And over the long term, we have underperformed the index by just about our expense ratio. So that's the main differential there. And we've got the different numbers here. You can see year to date that gold has been a very winning position versus the S&P. Gold has taken off quite a bit. And we do expect in the near future that with increasing inflationary concerns, that there may be further upside for the metal, whereas there might be some headwinds in the equity markets going forward, both politically and economically. So we believe that gold bullion can still be a very important part of the investment portfolio going forward. With that, I'm going to pass things back off to Brian, and then I'll come back near the end for some Q&A.
Great, thanks so much, Jason. I found that really informative, a really good look at what can be viewed as very complicated strategies, but I think you articulated those very, very well. On the screen, it says, keep calm and stay informed. Well, that stays with our theme of, from chaos comes opportunity. And, with 2020 being the way it is, way it continues to be, quite honestly, it's great to have information at your fingertips. And one of the great things about working with flexible plan investments as a sub-advisor, and I will note that you can also, should you choose to engage flexible plan as an SMA manager as well. But today we're talking about the mutual funds, which they sub-advise for under the Quantified and Gold Bullion brands. Flexible plan does a fantastic job of providing transparency for what they do. And part of that is daily holdings of all the mutual funds of which they manage. And this is a screenshot from the Flexible Plan website that shows you where you can pull that information from. So for the quantified funds, the STF fund, you can choose a calendar date and see just how that exposure looked on that day, which Jason went through on a very I'll say busy chart, but it was certainly a very involved chart, but we'll show you what that looks like to you. And then also some additional resources for the Gold Bullion Strategy Fund. As I mentioned, you go in, you choose a date for the STF fund, and you can see what the exposure level is. And the chart that we're looking at, especially around that March time period, mirrors what Jason showed you earlier. It's just this is the public view that they make available. This is really informative and, again, in line with the idea of transparency. Additionally, on the Flexible Plan website, really kudos to the folks at Flexible Plan in terms of they're really prolific writers and provide a lot of information to the folks that work with them. And that certainly carries over into the mutual funds. So there's regular commentary that's put out to keep you informed about the funds, what they're doing, and market conditions. So it's really a great relationship we have with Flexible Plan. They do a great job under the Quantified brand and the Global Bullion Strategy Fund. Lots of great information for you, the advisor, and in turn, your clients. So with that, we're going to wrap up the formal presentation and move into the question and answer format. We do have a number of questions coming in. I'll remind you, if you do have questions, please use the interface to submit your question. We'll do our best to get to them. We are operating under a time limit today. So with that, we're going to jump into a couple of questions. All right. First question coming in And Jason, I think you hit on this a little bit, but it talks about, you mentioned this is an absolute return fund, but yet being aggressive. Where should this fit in someone's portfolio?
This really needs to be a satellite position that they use to augment portfolio returns. So it is an absolute return portfolio, so it's not going to be correlated to equity markets, particularly in equity bear markets. But keep in mind that it is an aggressive strategy, so we don't recommend it as a core position, but something to augment both the risk and return of a portfolio. And if you're looking for something that has a little bit of lower beta on the downside, this is also going to be something that can do that, particularly in sustained bear markets. But definitely an aggressive satellite position.
All right, good. I think that paints a really good picture for folks. Thank you. Next question coming in has to do with futures. The gist of the question is, you've spoken about futures in the different portfolios. There's concerns about risks in dealing with futures positions. What can you inform the advisors on today's call about in terms of using the futures and how you mitigate the risk of using futures?
Well, so we target specific leverage values. So there's not going to be too much additional risk in terms of the leverage that we seek. And the futures that we use also are on the NASDAQ 100. So it's an extremely liquid, very deep market. So the risk that you'd get from the futures exposure is going to be extremely minimal, particularly because of the security that we're using and how we're targeting risk. So our leverage values are going to be within the values that I've set out before. So no more than double leverage for the fund, no more than one-time inverse position. So the way that we have the strategy set up, there really is a fairly minimal risk from using futures. They're just a tool that we use to gain exposure.
All right, great. Thanks for addressing that. It can be a complicated subject for some folks. I think we have time, for one more question. This has to do with the gold fund. You mentioned the gold fund versus GLD. So the bigger question is why the mutual fund versus the ETF? Why would you use the mutual fund versus the ETF?
So there are quite a few differences in the way that theirs is done. So GLD obviously is an ETF. Not all clients are going to have access to ETFs, but we do see that changing through time. Another big issue is going to be how it's taxed. So the GLD fund is going to be taxed differently than the way that we've set up ours. Ours, you've got a traditional tax investment form. And for GLD, it's taxed as a long-term capital gain rate of 28%. So, and that's specific for physical gold and silver. So there is an advantage of investing with us. The capital gain rates, the normal long-term capital gain rates are 15 or 20%, whereas anything like GLD being a physical one is going to be taxed at a much higher rate of 28%. So that's one very significant difference between them. So it's both availability and taxation, I would say, are going to be the major key points here.
Yeah, great points. One thing that I would add on to that from a distribution perspective in terms of distributing mutual funds and like you said, in terms of availability, a lot of times we see that folks in 401k plans certainly don't have access to ETFs, but additionally the funds in general, one, they're widely available on just about every platform that's out there to advisors, but two, they're generally available on a no transaction fee basis versus an ETF where you generally have to pay a commission to access that equity position. So just another point of clarification there. So I think we're running up on our time limit here. I think it's been a really informative session that we've had. Up on the screen, you'll see our contact information. So again, thank you for joining us. I hope you found this to be really informative. We recorded the webinar today, so we can certainly make it available to you. As a matter of follow-up, we'll reach out to everybody who is on the call today to see if you need more information. Again, you can find more information at quantifiedfunds.com, goldbullionstrategyfund.com, or directly here at Advisors Preferred at our website, and my phone number is on the screen as well. Thank you again for joining us. Again, this is a series. Tomorrow we'll be hosting the folks from Spectrum Investments, and very much look forward to that. We hope to see you there tomorrow at the same time. Thank you again, and have a great night. Thank you, Jason.
Thanks.